Hey guys, it's Johnny W. Pro here, and I'm back today to talk about forex trading and what can happen with spreads and margins and what you're doing by pairing up currencies. How it works is you actually deal with pairs of currency, like our US dollar against the euro, and each currency has a change in movement, and you pair them up and look for gains or losses. There's a spread that's given by the exchange, i.e., they think that the difference between the US and the euro will be, for an example, maybe $1.25. And if they think it's only going to change 3 cents in that day, you can beat the spread by making your own prediction and winning money. This type of trading is still largely unregulated, and you usually go to a broker to make the trade. You're basically making bets on if a global currency is going to go up or down farther than what the market and the economists say that it will. Going long is when you're betting that it'll be much more or a larger dividend, like rising against the yen. And going short is when you think that maybe it'll lose more than predicted. And basically, when you do this, you can get your data from the Wall Street Journal. You can get your data from emerging markets. And some people have strategies to do it before or after economists and Federal Reserve make major announcements. It's a little bit harder to know how these are going to affect your gains. And sometimes info that people would consider inside info or great info, you really have to nail down to know how our currency is going to stand up against each other. For strategies I've used, it's good to not make trades too long or too short just for thrills. Sometimes all of a sudden, someone involved in forex trading will want to trade and just feel that the yen is going to really explode, when maybe in the deep back of his mind, he knows that it's not, that this is just, he wants the thrill of a gamble, and he may lose. Another strategy I use is that I only risk a maximum of about 6% of what I hold. Some people, even in this economy, will go up to 25%. And if you really win on that perfect bet, that's great. But if you force yourself to only trade, maybe 4 or 6%, even if you feel you have a sure thing, for example, the US against the euro, if you're really watching the dollar, you're really watching the economy, and you think that you can get a long gain, you might not want to. Some people will lose the first year and be out of the game by going up to 20, 40, even 50% of their whole account or their whole savings or holdings on one trade. And if you do this with 6% and you win, you could always say, what if I had done 50% and one more? But I'll tell you what, if you're only doing 6%, at least you're not losing big when you do lose. There's many combos you can do, and when the market moves, it's hard to stay focused. And as you read about currencies, it's best to pair with larger nations. I mean, you can start reading into small islands, Gibraltar, Africa, places like that. There's gains to be had. There are brokers who will take those long and small risks, but it is best to stay with, India, currencies, Brazil, things you know. And this is a totally different game because you're pitting two actual forms of money against each other. Once again, I'm Johnny W. Pro. This was a little bit about forex trading, how it works, and some strategies I have to just stay alive my first year.